Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up there and names, I'll tell you what.
Bills paid by other people, life was never this good.
So as a real estate investor, I really have my hands in the housing market. Not as much as a real estate agent these days, but online, visiting properties and looking at open houses, I still have my pulse on the housing market, at least in the Midwest. And as I was looking, I can now officially say that the housing market has cooled off. What do I mean by that? So we're not seeing bidding wars anymore. Housing is way too overpriced. No one is really trying to pay these prices. And I was just thinking, if I had to buy today the same properties that I had, I would not be cash flowing whatsoever. It would just be a bad decision. So when people ask me, hey bro, why are you not buying? Or hey, how can I do what you do? It's a lot more difficult now in this market, but it's not impossible. So I just coach someone through, hey, you have $30,000, you just finished college. Okay, this is what you do. This is how you house hack your first property. If you want to know how to do that as well, if you want more information on what house hacking is and things like that, we can save that for another video. But I just got this in the mail. I'm not sure if you can see that. And so I'll read this to you. It says, Festus, whether you're starting your house hunt or ready to make an offer, we can help. Mortgage company, said mortgage company, has a 1% mortgage markdown. It's a discount on your monthly payment by reducing your interest rate by a full percentage point for 1 year. Plus, we're offering you up to $1,500 in credit for future refinance. Okay, so this is what's happening. This is what I think as an investor when I see this. One, I'm getting 1% off on my mortgage, but I know that if I shop my mortgage rate around, I might not get a whole percentage off for a whole year, but I will definitely get a better rate than whatever this company is going to offer me. So let's say this company offers me a 5.9% rate, but because of the markdown, I get 4.9%. Although I could go to another company and get 5.2%, you're enticed by that 4.9% rate for 1 year, and so you get sucked in, and they're really beating you over the head with a higher interest rate than what you could have gotten. Now, I don't know that for sure, but those are the things that come to my mind, right? Maybe they do offer me a 5.2% rate, and then they still mark it down to 4.2%. Now, that's definitely a win, and that's something that you should definitely consider. When they say $1,500 towards a future refinance, now this is somewhat valuable, but really is of no consequence. For someone like me, I don't really look to refinance, and if I did look to refinance, I would refinance to a smaller loan. So maybe if I get a 30-year mortgage and after 9 years I want to refinance, I'm going to refinance to a 20-year mortgage. Not every mortgage company does a 20-year mortgage, so you have to look for those that do. Most are going to do 10, 15, 25, and 30. But I'm going to look specifically for a 20-year mortgage in this case. A $1,500 credit will definitely go a long way towards that as well. But you have to do it with that same company, which limits your ability to really shop that around, right? Maybe someone is going to be willing to match that credit. Maybe they'll put it at the tail end so that you don't see it in the reports, however it may go. And maybe they may even boost that closing cost a little bit higher so that when you do get that $1,500 credit, it's not as significant. Maybe it becomes a $700 credit instead because of all the fees. You don't know that. I don't know that. Again, maybe they might have the best closing cost and then still add that $1,500 credit, which is a win-win. So in some of my future videos, I haven't talked about loans in a while and mortgage loans in a while. If you know my story, I went conventional with both of my properties. Why did I go conventional? I'm not scared of private mortgage insurance. I did not put 20% down. I put 10% down on all the properties that I own. And I knew that when it does hit 20%, the PMI would go away. The private mortgage insurance would go away. I also knew that just because a FHA loan offers you a cheaper interest rate, I don't want to have to necessarily be stuck with the PMI for the entirety of the loan. And I also knew that I would get a lower interest rate with a 10% down payment versus a 20% down payment. And so that really even made my offer easier to make for the 20%, for the 10% versus the 20, and for the 10% versus the 5, because at a 10% interest rate, you also get a better rate than a 5% interest rate, at least as it stands today. They are looking to change that, and I thought it was supposed to go into effect already, but it has not. And so if you were to put 10% down, even right now in this market in 2024 of March, you would be able to get a better rate putting 10% down versus any other percentage. If you do find a percentage that's better than 10% in terms of interest rate, comment that in the comment section down below so that we can all educate ourselves on what percentages are better. But 10% is better than 5 and is better than 20 in terms of getting that interest rate down. I also like the fact that the PMI comes off very, very quickly when you have that low interest rate, which I got during 2021. I believe it was supposed to take 5 years for the first property, and then it was supposed to take about 6.5 years for the second property. But because I've been paying both of my properties down significantly, it's probably all going to be paid off by 2020. The PMI will be off by 2025 for sure on both of them. One property is more further along than the other because I had that one for about 10 months longer. So that's 10 months of more payments. And so, you know, that does its thing as well. So with that being said, I also want to talk about 2-1 buy downs. So what is a 2-1 buy down? That's when you have a mortgage interest rate, maybe it's 6%, but you buy it down by 2 points for the first year and then 1 point for the second year. So your 6% interest rate is a 4% rate, which allows you to get into the property. Maybe you're assuming you're going to get a higher income raise. Maybe you're assuming that you'll be out of the property in 2 years and renting it out. Maybe you're assuming that there's going to be an increase in demand for this property and the appreciation will allow you to sell it for a profit. But you buy it at 6% and you get the 2% markdown for the first year. Okay? Then you say, ooh, I didn't get enough appreciation, so let me hold on to it for 1 more year. Now it's at 5% interest rate. Ooh. Then that next year passed and it's at 6% interest rate. You're already looking to sell the property because you don't want to carry this loan at 6%. It's only been 2 years. You only put 3.5% down when you purchased it. You really can't afford it at a 6% interest rate. And so you're looking to sell. Good news is that in this housing market, it has been appreciating, just not as fast. So maybe it's appreciated about $30,000 and now you're looking to sell. You're going at minimum, break even and maybe get a $10,000 back due at closing. So in that case, was it really worth it to rent essentially a house for 2 years? I don't really think so. Are you going to be able to refinance? You probably can refinance with 2 years of payments at a 6% interest rate with 3.5% down with the appreciation of $30,000 depending on what type of home you bought. You might just be at that 20% mark to where you can refinance to another 30-year mortgage. But your rate probably won't be that much better. Maybe you switch to an ARM just to make the payments. I don't really know what to tell you. Maybe you'll have to put money down on the principal just so that you can refinance if you have money to spare after all of those interest payments and all those mortgage payments that you've had to make. But the 2-1 buy down is not something that I would suggest. It's very similar to an ARM. In fact, I think ARMs are better because it allows for way more wiggle room. So for example, you can have a 5-year ARM, and all ARMs are really a 30-year mortgage. But for the first 5 years is going to be on a set, interest rate, and then it will change the rate based on where interest rates are. So it might go up depending on how many points it's supposed to go up in that first year, or it might go down. There is a cap on how high it can go up. And you can speak to your mortgage lender to know what cap that is. It might be 5 points up, or it might be 5 points down. But there is a cap on how much you can pay and how much you won't pay. So if you have a 2% mortgage rate and your cap is a 5 cap, you can only go up to a 7% mortgage rate. And I say only as if that's not a lot. But there's also caps on how much you can go up in a year, which might be a point, it might be 2 points. So for example, if you had a 2% mortgage rate and then now your 5 years are due and you're in this year where rates are at almost 7%, the most you can go up is to a 4% mortgage rate. Now that is still very significant to someone who is paying 2%, saving money, investing. In these type of situations, I'm going to be working extremely hard to pay off the home before that basically teaser rate expires, and before I'm paying an arm and a leg for the property. So I'm going to try and pay that down as much as possible while I have that lower rate, because not all debt is good debt, and when it's a primary residence, is not good debt. So no matter how much you consider it a savings account, or no matter how much you think that renting is a bad idea, sometimes it's a good idea. It just depends on the person. So with that being said, when you do good with your finances, when you do good with paying bills on time and just being a good steward of your finances and money, you'll get little offers like that, 1% buy down for a year. To me, that's not really a significant offer. To me, it's really not an offer whatsoever. It doesn't show that they value me as a customer, and so that's not something that I would go for. And it's not even something that I would look at compared to all the mortgage options that are out there and the lending tools that are out there. This is not something that I would take seriously. But what do you think? Let me know in the comment section down below, and watch my videos on all the loan types that I talk about, and you can see why I did not choose this option when it comes to looking at real estate. So if you like, again, leave a like, comment, and subscribe. You know I post every single day at 8 a.m. daily on YouTube and on Rumble, and I can't wait to see you on the next one. Peace.